Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about NCC, a stock that is in the infrastructure domain and many people are invested in it. So let's understand what needs to be done in the share. Let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position into any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Now about NCC. Well, the company was established in 1978 and they provide civil engineering services for major engineering projects. So they basically provide all the engineering and design domain for establishing, say, metro rail projects or infrastructure projects, whether it is power, mining, water, as I said, railway projects, etc. So they provide engineering support and design support to the companies which get the order for these major projects. The market cap of the company is nearly 3,500 crore and is trading at 7 times current earnings. So not quite very expensive, but will the stock perform or not? It depends on the earnings, and will the earnings come in or not? Let's understand that. So if we look at the financials, the sales were down 40% year on year in second quarter of this year, and the PAT was down around 37%. The debt has been rising continuously, although the return on equity is 14.5%, and there's good operating profit margin, but due to the high debt, the net profit has come in lower. Every quarter, so over the last 8-10 quarters, it has been a declining trend, and that is why the stock has been battered out of shape. So one needs to understand that when you buy into high debt companies or high debt infrastructure companies with the current infrastructure slowdown, it is very difficult to see a recovery very soon. So the stock performance has been pretty bad. Stock has been falling relentlessly since 2017 and is down nearly 60% from its peak of 2017 December. So one needs to take that into account. The promoter holding is very low at around 18%, and that is a cause for concern. Although there is a good DII and FII holding, and eventually you can say that retail investor participation is only 26%, but still the promoter holding at 18% looks extremely low. So this has basically become a trading play, and the profits have been declining continuously, as I mentioned, over the last 8 to 10 quarters. What has been the reasons for decline? One needs to understand that as well. Well, the infrastructure slowdown across the country. So as I mentioned that there's a slowdown with respect to real estate and infrastructure, and even if there is government spending in infrastructure, we have seen a continuous slowdown in the level of projects getting approved and then final sanction and everything else. So eventually when the numbers come in or the profits come in, it takes a very long time at the moment. So over the last 2 years there have been a lot of projects in the order book of NCC, but yet the numbers have not come in because the execution has not been pretty good, and this is because of less amount of approvals that are given to the projects, and there are many projects that are stalled. So one needs to take that into consideration when you're buying into high gestation period companies which have high capex cycles, etc., such as you would say capital goods company, infrastructure or real estate company, and NCC falls into that bracket. When we had the real run up in 2003 to 2007, these companies really did well because there was an infrastructure boom in the country with malls and etc. being built during that period, and it was the onset of metro rail projects, etc., as well. So at this point of time, with the infrastructure slowdown, there are very less projects at hand for NCC to be executed. The low promoter holding is another cause for concern, and that's why the decline, because at 18%, if there's a promoter holding at 18%, that is not really good. The profits have continuously declined. So again, the company is more or less in losses rather than profits if we take into consideration the last 9 to 12 quarters. And that has also led to the people staying away from such company. Plus, what we have seen in small caps, that there have been a massive sell-off across the board. So no stock has been spared, whether it is good, bad, or ugly. And in fact, in the space of infrastructure, capital goods, etc., the clampdown has been even more, and we have seen companies lose 80-90% of their wealth during the last couple of years because of people looking for safety, people looking for companies which have a better track record in terms of profitability, and that even if they give 8-10% profit growth over years, they are giving a lot of credibility to those companies. So people are getting more towards them, like Nestle, HUL, etc., rather than buying into infrastructure or capital goods companies. So these are the reasons why the stock has declined so much over the years. If we look at the technical, so if we look at the technical parts, there has been a strong long-term support around the 50-55 levels, and this is where the stock is currently trading at. We look at the current price is at 55, so probably one can take a stop at around 50 rupees and still buy, but this is a very risky buy at these levels, and one needs to look at the numbers as well as what is the ground condition in order to get into the stock. Even if you want to trade into it for the next 2 to 3 months, let the stock settle down, let it move above 60, and only then buy. They have a strong resistance. The company or the stock has strong resistance between 68 to 71 levels. One has to take that into consideration. So probably if you buy at around 50 to 53, keep a stop at 50 and look for 60-62 levels. But again, this is a very risky buy with the kind of numbers that NCC is coming out with. The 200 DMA is at 81, and it has a very high share capital. So what happens is, even if there's a big buying taking place, there's a lot of shares that are being sold into later on. If there's low share capital, then even little bit of buying would take the stock higher. That is my understanding of the experience of the stocks that I've traded in. High DII holding and decent FII holding is pretty good for the company. So you can keep a stop not at 54 because the stock is already trading at 55. Probably keep a stop at 50 and trade into it. But again, do not expect a lot out of this company. So what needs to be done? A very risky buy with strict stop loss is what I think, and it is better to buy low debt infra companies or real estate companies. We have Godrej Properties which have low debt. We have Brigade Enterprises, and there are many others which are into real estate infrastructure which have very low debt. I have talked about NBCC and how it has done over years, and with getting government orders, it is pretty good stock to buy at in current scenario. If even if you buy at these levels of 50-55, do not expect a turnaround immediately, and probably hold the stock for at least 4 to 5 years, and then you'll see in between that period. Do not hold it for all the 5 years, but whenever you see the turnaround in the stock moving up a lot, take the profits and get out of this sector. The infrastructure sector is in trouble over the last couple of years, and looks like it's going to be in trouble for the most parts of the next few quarters. So one has to take that into consideration and kindly have less than 5% exposure into these stocks. So this was my video on NCC. Please like and subscribe my channel, hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.